we have talked about how to calculate total goodwill and how to allocate total goodwill between controlling and non-controlling interest. Now let's look at how would it affect our consolidation process. So this is an example from last class. And can you tell me whether this example, the parent paid a control premium or not to acquire the controlling interest? Please take 1 minute, think about it. In this example, is there control premium or not? Right, so this example is a no control premium example. The parent acquired 80% of subsidiaries stock for 9.75 per share, and the shares are traded at 9.75 per share. Or in other words, the parent does not pay more to acquire a controlling interest. So it is no control premium situation. So that's why in the previous, in last class, we didn't really, when we talk about A2 entry, we didn't really spend much time talking about it. We just allocated according to the percentage of ownership, because in the situation of no control premium, there's really like we just do everything the same as before. The goodwill is allocated according to the percentage of ownership between controlling and non-controlling interest. So there's not much we need to worry about with regard to the allocation of goodwill when there's no control premium. And now let's look at another example. If you go on island under your class 7, under this class session, you're going to see a handout there. So this is an example that when the parent is paying a control premium. The only differences are those places which is revised by handwriting. So instead of 9.75 per share, now the parent is paying $11 per share. And then because the parent is paying $11 per share, so the consideration transfer changed, right? So now it is $11 multiplied by 80%, multiplied by 100,000 outstanding stocks. So that gives us the total consideration transfer becomes 880,000. And because the consideration transfer changed, so the total fair value of the firm also changed. The non-controlling interest doesn't change, but now the total fair value of the firm becomes 880,000 plus 195,000. That gives us 1,075,000. And when we do the amortization allocation, the total value of the firm now becomes 1,075,000. And then the acquiree's book value, its book value doesn't change. It's still 740. So which means that the fair value in excess of book value would change. So this will change, and which would result in a change in total goodwill. So now total goodwill becomes 125,000. So let's first do the goodwill allocation. We have controlling interest and non-controlling interest and total. The fair value of the firm is consideration transferred, which is 880,000 that we just calculated here, plus 195,000 fair value of non-controlling interest. So the total fair value of the firm is 1,075,000. And the fair value of the net identifiable asset of the firm. So the book value of its net identifiable asset is 740,000. And then we have all of those assets and liability, which has a difference between fair and book value. So we need to adjust the book value by the difference. Trademark fair value is 60,000 more. Patented technology has a difference between fair and book value of 120,000. And then minus 10,000 for equipment, plus 40,000 for long-term liabilities. So this gives us 950,000. And this 950,000, we're going to allocate it according to the percentage of ownership between controlling and non-controlling interest. 80% of this 950 is allocated to controlling interest. So controlling interest gets 760,000. Non-controlling interest has 20% of those. So non-controlling interest has 190,000. And total goodwill is the difference between 1,075,000 and 950,000. So total goodwill is 125,000. And then in calculate the proportion which belong to controlling interest, we take 880,000 minus 760,000. That will give us 120,000. And then for the goodwill which belong to non-controlling interest, we either take 195,000 minus 190,000. That will give us 5,000. So this is one way to calculate it. Another way to calculate this 5,000 is we take the total goodwill 125,000 minus 120,000, which belong to the controlling interest. That will give us 5,000 as well, the same number. And then there's a third way to calculate this. So in this situation, how much is the control premium paid? For each share of stock, the parent is paying $11 for something which is traded at $9.75. So for each share, the parent is paying $1.25 more. And then what is the total amount of control premium the parent is paying? So it acquires 80% of the outstanding 100,000 shares. So the total control premium paid is 100,000. And this 100,000 control premium paid is allocated 100% to the parent's goodwill. So the parent's goodwill, 100,000 control premium. And then the total goodwill is 125,000. After we take out 100,000, how much is left? We have 25,000 left. And this 25,000, 80% goes to controlling interest, 20% goes to non-controlling interest. Multiply by 80%. And 125,000 minus 100,000 multiplied by 20%. That is goodwill belong to the non-controlling interest. So this 25,000 multiplied by 20% is 5,000 as well. It will give you the same answer. And this 100,000 plus 25,000 multiplied by 80,000, that is 120,000. That will give you the same answer as this one. So those are just different ways to calculate it. But no matter which way you are using, they will all give you the same answer. So now we have calculated the goodwill, the portion of goodwill which belong to the controlling versus non-controlling interest. Now let's look at how to do the consolidation worksheet. The consolidation worksheet is very similar as before. The only difference is actually there's maybe just two differences compared with the one we did in last class. The first difference is the parent book will be a little bit different because now we are paying a control premium to acquire subsidiaries stock. And the second difference is in A2 entry. Now we do not allocate goodwill according to the percentage of ownership because we have the presence of this control premium. So we cannot allocate it just according to the percentage of ownership. So Let's first look at the parent book. How will the parent book be different? The parent book, the major difference is in the investment account. So the investment account here, now the consideration transferred is 880,000. Actually, that's the only difference. And then we need to add the subsequent year's income and minus all of the subsequent year's dividend and minus all of the subsequent amortization. So income minus dividend, that is basically the change in retained earning. And then multiply by the ownership percentage. That will give us 952,000. So that is how we calculate this investment account here. Yeah. And then consolidation entry S. S, the purpose is to eliminate subsidiaries stockholders equity account. So subsidiary has common stock, 230. It has beginning retained earning of 580,000. And it is allocated 80% belong to the parents, 20% belong to non-controlling interest. So this column is basically the same as before. Investment goes down by 80% of that is 648. Non-controlling interest gets 162,000. This is consolidation entry S. Consolidation entry A is also the same as before. We use it to mark up assets and liability from their book value to fair value. So trademark is marked up by 60,000. This column is the same as last class. And then, oh, sorry. Trademark 60,000. Patented technology 114,000. So if you do not remember this column, just go back to look at the video for last class. Equipment goes down by 9,000 and long-term liability goes up by 35,000. And then we allocate this amount, the total of this, the difference between fair and book value, 80% to the parent and 20% to the subsidiary. So parent investment account goes down by 160,000. And non-controlling interest gets 40,000. Consolidation entry A2, total goodwill now becomes 125,000. And then we just calculated here, 120 belongs to controlling interest, 5,000 belongs to non-controlling interest. So this 125, we do not allocate it according to the percentage of ownership. Instead, we already do the calculation here. Parent investment account goes down by 120,000. And non-controlling interest gets 5,000. Consolidation entry I is the same as before. Now we use it to eliminate this 64,000 income recognized, subsidiaries income recognized by parent. Consolidation entry D, we use it to eliminate intra-entity dividend. So because in the presence of non-controlling interest, 50,000, that is the total dividend. Parent gets 80% of that. So that will give us, so 40,000, that is intra-entity dividend payment. And then, oh, sorry, this is for this. And consolidation entry E, the purpose is to recognize current year amortization. So we have depreciation expense. This is exactly the same as what we did in last class. 1,000 depreciation expense, amortization expense 6,000, interest expense 5,000. And then accordingly, patented technology goes down by 6,000. Equipment goes up by 1,000, and long-term liability, we need to credit 5,000. And then this column is, okay, so it is not, this is non-controlling interest. This column is for non-controlling interest. And then for this column, as we said, how to do it last class. So we need to first calculate the beginning non-controlling interest. 162 plus 40 plus 5, that is 213. Oh, sorry. So the beginning non-controlling interest is 207,000. And then the current year net income, which belongs to non-controlling interest, is subsidiaries current year net income, which is 90,000, minus the current year amortization, which is 10,000. Multiplied by non-controlling interest percentage of ownership. So this is also the same as last class. That gives us 16,000. And then the dividend, which belongs to non-controlling interest, is 10,000. So 27,000 plus 16,000 minus 10,000, the ending non-controlling interest is 213,000. So, and then that's the last column. For revenue, so all of the items on the income statement up until here, we just add them up horizontally. So consolidated revenue is 1,340,000. Cost of goods sold is 544. Depreciation expense is 79,000. Amortization expense 181,000. Interest expense 120,000. And equity in subsidiary earnings, this should go to 0. The consolidated net income are the sum of all of those, and that is 416,000. So this is allocated between controlling and non-controlling interest. Non-controlling interest gets 16,000. So the controlling interest gets 400,000. Controlling interest 400,000 is carried over to a statement of retained earnings. On your statement of retained earnings, the beginning retained earning is 860,000. Your current year net income is 400,000. Dividend is 60,000. So again, we already talked about it last class. But again, so this 60,000 can be viewed either as you take 400,000 plus 90,000. Oh, sorry, you take 60,000 plus 50,000 minus 40,000. And then this 10,000 should be viewed as minus 10,000. That will give you 60,000. Or another way to look at this is you take 60,000 plus 50,000 minus 40, you take 60,000 minus 50, you take 60 plus 50, and then you minus 40, so that will give you 70,000. And this 70,000 is divided between controlling and non-controlling interest. Because controlling interest already get 10,000, so the non-controlling interest gets 60,000. So those are the two ways to look at this. But one thing to pay attention here is this 10,000, even though it is not written in parentheses, but you should view it as you need to, when you calculate it horizontally, you need to take it out. And then if you add up all of the items in your statement of return earning, you are going to get your ending return earning, which is 1,200,000. And this 1,200,000 is carried over to your balance sheet. So on your balance sheet, your total current asset is 1,171,000. Your investment account should go to 0. Trademark is 659,000. Patented technology is 1,528,000. Equipment is 542,000. Goodwill is 25,000. And then if you add all of your assets up, that will give you your total asset, which is 3,925,000. On your liability and shareholders' equity side, your long-term liability is 1,642,000. Common stock is 870,000. Non-controlling interest is 213,000 that we already calculated here. And then if you add up everything in the liability and shareholders' equity side, you are going to get your total liability and shareholders' equity, which is 3,925,000. And then the last check is your total assets should be equal to your total liability and shareholders' equity. And then this is about this consolidation worksheet when there is control premium. And if you compare this worksheet with the previous worksheet that we did in last class, is there really a lot of difference? There is not really a lot of difference, right? So some of the differences here, because now we are paying a different amount. So we're paying a control premium to acquire the subsidiary. So the consideration transferred is different. And then what is the result? The result is that our goodwill will be different. So the goodwill in the previous example is 25. However, in this, sorry, so here that is 125, sorry. However, in this example, our goodwill is 125. And then, is there any other difference? So because we're not paying a control premium, so we're paying more. So the current asset in this situation is 1,171 versus in the previous situation, oh, sorry. So I made a typo again here. The current asset here is 1,071,000. Sorry about that. Versus in the previous situation, your current asset is 1,171,000. Is there any other difference? So I guess that's it, right? That's all of the differences between the control premium and non-control premium situation. We're paying a control premium, we're paying more. So our current asset would become less, but all of those overpayment becomes our goodwill. So we are having more goodwill in this situation. So that's all of the difference between these two situations.